Good morning, Market Chameleons. Everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon first show of the new year. Please, before we get started, take a look at the shared disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows, is for informational purposes only concerning Market Chameleon tools and processes. With that, D, good Thursday morning, I think. Happy New Year,
Good
2024.
morning. Happy New
First
Year.
show.
Happy New Year, everyone. Yep. I'm gonna get started to share my screen. Hopefully everybody had a good New Year, day off. Today, what we'll cover is a tool that tracks the performance of option premiums. And in this particular tool, it's going to look at what we'll do is look at an options strat. You're buying a call and a put, and how did that historically or in the most recent history perform in different stocks? And the idea there is, if you're a trader and you're curious about, well, how would a strategy of selling options in general work, or buying options in general work? So you're buying premium and you don't maybe necessarily have a directional bias, but you're looking at, just volatility and movement. So in that case, we could look at a straddle and see, well, how is the straddle priced relative at the start relative to how finished? Did it tend to be underpriced or overpriced, and by how much? So these are some of the questions as traders we want to kind of get a sense for, how in the most recent history the options have been performing. And in this situation, we're going to look at a screener that helps us do this all from one page instead of going from stock to stock. We'll create this screener and it'll be easier to kind of find those answers here. Now, to find this particular page, we could go under options, menu up top, and over here, tools, straddle, and wing backtest. So that's what I'm on. You click on that and you end up on this page. So here we have some filters up top, and then we have the data table below that you could filter out. And I'm going to just go kind of from left to right to describe to you what these data elements or statistics mean. And then we're going to perform a couple screens, narrow down candidates, and just discuss those results. Okay, so in this table, we could see from left to right, we have the symbol. In this case, it's AAPL for Apple. If you click on this info sheet and you're not sure what the symbol is, if you click on it, you get more details regarding this symbol. And you can see you could even tab through and you don't have to leave the page. Here we see it's Apple, and you get lots of different data and information regarding that stock. I'm going to close this and let's continue. Here we define the strategy that we're tracking. And this is the at the money ATM straddle, and it's unhedged. In other words, it's going to look at an at the money straddle, and it's not going to, if there's a delta in that straddle, for instance, based when we took that snapshot, it's not going to hedge that delta. And the delta can come from the stock being somewhat above or below that strike that we're referencing. So since we're referencing actual options, and the stock could be, let's say, 101, 102, and the closest strike is 100, well, that would mean the call would be more in the money, the put would be more out of the money, so it has a long delta. or vice versa if it's below the strike. And you can't always find a strike that exactly matches the stock price at any given moment. So the stock could be a little bit above, a little bit below the strike, which in that case, there is some delta to that option strategy, meaning you'd have at the start of it, you'll have a little bit more of a bullish bias or bearish bias. So this is looking at an unhedged, so finds the closest strike to the spot price and then tracks how did those options perform, the call and put. That's the straddle, if you bought the call and put. Here we see, this is for reference, just the market cap of the stock, Apple 3.8 trillion. And this allows you to either sort by highest to lowest or filter out by market cap. So you have that data point there. Next to it, we have the average daily option volume in Apple at 781,570. This allows you to sort or filter by the average daily trading volume in that stock. And that helps just to get a sense of the liquidity in the stock and prices, or how much trading activity do we have in this option. And the more trading activity, the more liquid options are for trading, the price discovery process, and so forth. So that gives us a sense of the liquidity, average daily option volume. Next to it, we see the average bid-ask spread in the straddle in our observations. So on average, when we track this strategy, the bid-ask spread was 5 cents. And that also is a liquidity measure. If you have a very wide spread, then the cost of execution is higher, right? Because you don't, if it's $1 wide and you needed to get an immediate fill, you'd have to pay more than if it was 5 cents wide, the difference between the bid and ask. Again, this is something you could sort by or filter. And it's important just to know that metric. In this situation, we're also looking at the last 12 observations. So we're looking at the performance week to week. So this is starting at the beginning of the week and holding the strategy to the end of the week. So if we open up on Monday, it would close on Friday. Okay, that's the time period. Because when we measure performance, we have to define, okay, are we looking at daily returns, weekly returns, monthly returns? This one is looking at 1 week range. Now, if that week is shortened, let's say like this week, we had New Year's, we weren't open on New Year's, it'll still look from Monday to Friday. It's just a shortened week, but it'll track that straddle start of the week to end of the week. Okay. Now, we could expand that over here if we wanted to go, 26 weeks or just the last 3 weeks. We could change that from the filters above. Let's stay on the last 12 weeks. Here, we could view the details. If you click on this, we're going to get the summary statistics for those observations to the right. If we wanted to go in deeper and view the actual details, you click on this, and then over here, it tells us the timestamp of the snapshot, the start time, timestamp of the end time, where the stock was, where the options were, what the value of the straddle was at the start, the premium, and what it was at the end, and then the returns. So we might come back to this. Let's just review everything that is visible in this table. So what are these stats now that we defined what we're tracking? The stats look at these straddles from the perspective of if you bought the premium, what was the premium at the end, right? So the starting point, the straddle cost you $10. If at the end of the week it was worth $5, well, that's a 50% loss, and that's a loss, right? If it's worth 10.01, well, it went up a penny, but that would be a win because it would be worth more at the end than it was at the beginning, right? So that would be what we would put in this column. The win rate is the percentage of our observations that the straddle was worth more at the end of the period than it was from the start of the period. Okay, gain value, appreciate it. In the last 12 weeks here in Apple, we could see that happen 33% of the time. So a third of the time, whatever the straddle was at the start, it was worth more at the end. Now, so that's one statistic. That doesn't tell you the full story, because with options, the amount that it could appreciate is unlimited, right? Supposedly, if you own a call, it could go to infinity. Not likely, but it's not always the same payout, right? It's not like 33% and you either make $5 or lose $5. Options don't work that way. Sometimes they can make 200, 300, 400%. So it's important to understand those dynamics too. Okay, I got a 33% historical success rate with this, but what was the average return? The average return could still be positive, right? It could still be positive, because even if 2/3 of the time, let's say that the 2/3 of the time, it lost on average 10%, but the other third of the time when it hits, you're making 400 or 500%. Well, at the end of the day, then that long strategy would have been profitable, right? Even if you incur more frequent losses, it still would make sense from the long side. If those times that it does hit and it moves, the move could be very big and astronomical. In order to get a sense of, that what the returns are, the total returns, we would have to look at all 12 returns and average them out. What's on average? What would have we made or lost? So that's what this is, average return. So it looks like on average, it was a 16% loss, right? So 16% loss in that straddle if you did these 12 observations. So another stat we could look at is the median return, and that helps us kind of get a sense of how much the average is skewed, because the average can get skewed because of outliers or very extreme. Maybe it could be just one move that really skewed that average. And to get a sense if there is a big skew, we could look at the median return. So if we took 12 observations, sorted them highest to lowest, then took our data and said, give me the slice in two, the best 50% and the worst 50% returns. And what is that number in the middle? So that's what this is. Half of the observations were better. It was negative 24%. Half the observations were better than this, half were worse. So that shows us that, yes, there's a slight skew to the upside, but it's still negative. Okay.
Hey, D.
Yeah.
Rob is asking, and I don't know how he's asking, Will, would Dimitri please explain how you can see the relative side of edge if edge in the straddle on a trade card showed up with positive edge?
I'm not sure how it's related to this, but maybe we'll do it on a different video. I think you're looking at like a trade idea card.
Maybe I'll copy and send it to you.
Yeah, maybe I'll cover it, and just so I don't go off this particular page and just start something new.
Sounds good.
Okay, but yeah, thanks for the question. I'll just look at that question, cover it maybe in tomorrow's video. So now we have these stats, and what else can we learn from this straddle? How much variability is there? We're talking about options, and options these are derivatives, and the returns could vary wildly, right? It's not like a stock, in a day has some volatility. It could be 1% up or down, 2% up or down, 0.5% up or down. But options are derivatives, so they can move around a lot. You're taking on more risk from that perspective. And to get a sense of it, we could take the standard deviation of those returns around the average and see, well, how much variability is on these particular strategies. So that's what this is, the standard deviation of the returns around the average. Okay. And we'll use this over here on the Sharpe ratio, but I'm going to come back to this. So what else can we learn from our data set? Well, why not look at what is the best return in the last 12 weeks and the worst? Right? If we sorted it from highs to lows, well, what was the highest return in this straddle? Was it 100%, 200%? And what's the worst? So in this situation, the worst return was 82%. So that means out of those 12 observations, none of them really probably closed right at the strike. So it was either the call was in the money, the put was in the money by somewhat, didn't cover the full cost or premium of the straddle, but 82% was the worst loss. The best one, the max, was 58%. Okay, so that gives you the range. You could see that even in the last 12 weeks, we didn't see any that doubled, tripled, or the max one was 58%. Now to kind of normalize or standardize what the risk, the potential reward versus the risk in those last 12 weeks, we could take the average return divided by the standard deviation of the returns and get this ratio. Now, of course, this is negative, so these were negative returns, right? These didn't work out from that perspective. But let's say we had a positive return, and then we divided it by the standard deviation of the returns and get the Sharpe ratio. And this helps us to kind of quantify the historical returns versus the variability or risk per unit. So imagine if you had a high return high average return with zero standard deviation, that would be great, right? Because let's say you made 10% every time on average, and it was never below 10% or above 10%. It was always exactly 10%. Well, of course, if you could, make high profits with no variability, then with no perceived risk, that's better than having risk, right? So that's what the lower the higher the return and the lower risk is preferable. That's what this ratio is trying to help us kind of get a sense of, like, well, where are the highest returns with the lowest variability. And we'd want to see some positive, in these cases, these are all negative, but you're looking for some positive ones, if to basically, support that strategy. So this is our stats that we could observe here, and we do have other strategies in this screener if we wanted to compare it or isolate a particular strategy. We can do that from the screener. We could look at a out of the money call with a 25 delta call, or an out of the money put, 25 delta put. So that's what some people like to do. Look at, well, what would it look like if you just did an out of the money put? Some people like to sell out of the money puts. Maybe some people like to buy out of the money puts as a hedge against their portfolio. Well, how much would it cost me? Every week, I bought a 25 delta put at the beginning of the week, held it to the end of the week to protect my portfolio. What was the cost of that? So that's another way to come here and just get a sense of what it's been doing in most recent history. So keep in mind, these are 12 weeks, not 12 days. So this would be 3 months of data. Now, let's say we wanted to just isolate this one at the money straddle unhedged. Come over here under strategy. We could do at the money straddle, and the hedging would just say unhedged. And now, since we isolated just this one particular strategy, we could even compare how different stocks perform using this strategy, right? Where did a particular stock have more frequent wins? And were there any particular stocks that may have been positive or did better in performance than other ones? Like over here now, we could see, well, Tesla in the last 12 weeks, the straddle was 50-50. Half the time it was profitable, half the time it wasn't profitable. Okay. That's week to week straddle. And on average, it had a pretty big return. It's a whopping 45% on average return. So if we kind of just went from left to right, we could see that the median return was 10%, meaning half the observations made more than 10%. Half the observations were below that. Standard deviations are very high. You can see 141. The worst return was 84%. The best return, 393%. So there you have, you could see a really big move probably in Tesla in the last 12 weeks, at least one of the weeks, where it gained almost 400%. So you could see why it's not only the win rate, the frequency of the success, but also when it is successful, you could just see from here, that the returns could be very high. You could have a very big move in a stock, and that straddle could return, more than 100%. 200, 300, almost 400% in this case. So if we took that average return, divided it by the standard deviation, we get this Sharpe ratio to show us how much return per unit of risk, basically. So we could kind of also compare them right down the line. Let's say we wanted to look at only those that had a positive return. So we could just isolate those and say, just show me the ones that had a positive average return. So let's do any positive. Click on that. And now you can see here, these are the stocks that the straddles on average were profitable, right? So on average in the last 12 weeks, if you did every time in the last 12 weeks, like in our observations, on average, they were positive. Doesn't mean always, it's just that's the averages. Okay. And these are the other stats. So even here, like in Google, you could see the average, you could see the win rate's 42%, but the average return was positive 11%. The median return was negative 33%. So you can see that the median return is still negative. There were more frequent losses than there were wins. But if we look at the max, the worst versus the best, you could see that this skewed it up. There's a return there 1 week where the straddle itself gained 254%. Okay. We could even look at it if we click view. Right now we have all these observations. So we could look at the unhedged. So here, 254%, the week of December 13th. Right, we could see the stock went from 176, the start of the week, to 191.38. The straddle, at the start, the contract, it was worth 392. If you bought a call and you bought a put, cost you $392. But the stock went up 8.4%. So the call was in the money. The put was out of the money. So the value of the call was $1,388. Right? That's a 254% gain in value. So that's really quickly how we could go and just start to answer some of these questions using this screener. All right, well, I'm going to stop right here.
That was awesome, D. We just hit the opening bell, first day of 2025 trading. Everyone have a great day. Remember to like this video, like us on Facebook, follow us all day, every day. Great job, D. Thanks so much.
Yep. Thanks, everyone, for joining. Stay safe out there and have a great trading day.